Have you ever looked at your S&P 500 ETF and thought, why is it so far behind the actual S&P 500 index? Or maybe you've checked your portfolio and thought, wait a minute, I'm pretty sure that stock went up by much more than this. It might not be the ETF's fault, and it's not your broker ripping you off on the stocks you've bought either. There's often a hidden force working behind the scenes, currency movements. In this video, we're talking all things FX, foreign exchange, and currency. How it affects your investments, what FX impact means on trading 212, and why even ETFs listed in pounds are not safe from currency impact. We'll also look at whether currency hedged ETFs are worth it, and all the things you should consider. Now, this video is not sponsored by Trading 212, but I will be using it throughout for examples and illustrative purposes. If you're using Trading 212 or thinking about getting started, this platform is actually one of the clearest when it comes to showing FX impact on your investments. If you want to give it a try, you can use the link in the description or scan the QR code on screen to get a free fractional share worth up to £100 when you sign up. Alternatively, after opening your account, head to the menu page in the app, go to the Use Promo Code section, and enter the promo code TOM within 10 days to claim the offer. This is an affiliate link and code, so I do earn a commission if you choose to use it, but it's at no extra cost for you, and it does help support the channel. Thank you. Let's clear up a common source of confusion straight away. FX fees and FX impact are two very different things. I've had comments in the past saying something along the lines of, why are the FX fees on Trading 212 so high? And this is usually because they've seen a negative FX impact on one of their holdings. However, FX fees are what your broker charges when they convert your money from one currency to another. For example, if you buy a US listed stock using pounds, you'll usually pay a small conversion fee to convert your pounds into dollars in order to be able to buy the stock. On Trading 212, this FX fee is currently 0.15%. On other platforms, those fees can be much higher, sometimes 1% or more, which can really eat into your returns. If you'd like to compare FX fees alongside other costs of different platforms with ease, you can get free access to my investment platform comparison sheet via the link in the description. FX impact, on the other hand, isn't a fee charged by your broker at all. It's the effect of currency movements on the value of your investment. And unlike fees, it can work in your favor or against you. If it is negative, it is not your broker ripping you off. On Trading 212, the FX impact shows on the stock page for investments you hold listed in a different currency, but that doesn't necessarily mean it's easy to understand. Many investors overlook it completely or don't realize how much it can skew performance over time. And as we'll show, the FX impact applies even when you can't see it listed separately too. Let's now turn to some examples to see how FX impact can play out. Let's say you buy a US stock for $100 and 6 months later it's up by 10% and now worth $110. Great, you have a 10% gain on sale, right? Well, maybe not. Let's say the pound has also strengthened against the dollar during that time by 3%. You're actually only going to be up by 7%. This is because as the pound has strengthened, each dollar gets less pounds upon sale than when you originally bought. Of course, on the other hand, if the pound has weakened by 3%, your return would actually be boosted to a 13% gain. It can work for you or against you. On Trading 212, as mentioned, the FX impact is clearly shown for stocks you hold in a different currency. For example, look at this ETF that I hold that trades in USD. The share price is actually up by 1.57% since I bought, but the FX impact is negative 3.75% because the pound has strengthened. So overall, I do actually have a negative unrealized result of 2.18%. To sum up FX impact, it is positive when the foreign currency strengthens relative to GBP. It's negative when the foreign currency weakens. I also like to say that it is worth putting a positive spin on it either way. If the pound has strengthened, your current investments may take a hit, but it means you're going to get more out of your next contribution because your pounds are going to buy more dollars. And if the pound has weakened, your current investments will have their return figure boosted, so you get to look at those nice green numbers we all like to see. But remember, the return is only real if you realize it and sell the position. So as a long-term investor, I personally don't pay too much attention to the FX impact. It's always going to swing up and down. So now let's turn to ETFs. You might think that by buying an ETF listed in GBP, you're avoiding all this. Well, unfortunately, that is not the case. Let's say you buy an S&P 500 ETF that's traded in pounds. Because it's listed in GBP, there are no FX fees, and you won't see any FX impact labelled on Trading 212. But behind the scenes, the ETF still holds US stocks priced in US dollars. So the ETF trades in GBP, but the underlying stocks are traded in USD. This means its performance will still be affected by exchange rate movements. If the pound strengthens, the ETF may underperform compared to its USD equivalent, even if the stocks themselves perform the same. We can see this year to date by plotting a chart with the GBP listed VUSA, the S&P 500 index, and the GBP to USD exchange rate. The USA has performed significantly worse than the S&P 500 index, as the pound has strengthened against the dollar year to date. So, as mentioned in the introduction, if you've ever wondered why your ETF is not matching the returns of the index or the returns of American YouTubers you watch, this is why. Whilst there's no FX fees and no visible FX impact listed on your broker, currency risk is still baked into the ETF's returns and current price. This does not mean you should go out and buy USD listed ETFs. There's a few reasons why you probably shouldn't do that. First of all, you'll then incur FX fees. Second, you can't just keep on switching based on currency movements given how unpredictable they are. But thirdly, most importantly, you're still going to get the FX impact. It just goes from being invisible baked in the price to actually being visible and listed separately on Trading 212. Say you bought a USD listed S&P 500 ETF at the start of the year, your FX impact would be showing up as negative due to the pound strengthening. You're not avoiding the currency risk, you're just switching up how it is displayed. But what about currency hedged ETFs? Are they a way to avoid currency risk altogether? Well, they are designed to protect investors from currency risk. Currency hedged ETFs and non-currency hedged ETFs use the same asset allocation, assuming they track the same index. The difference is that currency hedged ETFs typically use forward exchange contracts to hedge against exchange rate fluctuations. For example, if we compare the GSPX, a GBP hedged S&P 500 ETF, to the S&P 500 index on a one-year chart, we can see that it has matched the returns of the index pretty well, whereas VUSA has lagged significantly due to the recent pound strengthening. That sounds like a no-brainer then, right? Well, there are some pros and cons of currency hedged ETFs. Pros: your returns aren't dragged down if your home currency strengthens. You get purer exposure to the asset's performance, especially useful for short-term investing or tactical plays. It helps reduce volatility caused by currency moves. However, there are of course the cons. Higher fees. Hedged ETFs usually cost more due to the additional management needed and costs incurred by the fund provider. It'll also underperform a non-hedged ETF if the pound weakens. In this case, hedging removes the benefit when FX swings would have helped. And over the longer term, we have seen non-hedged ETFs outperform hedged ETFs because the pound has generally gotten weaker against the dollar. There's also another hidden cost: hedging drift. This is a bit complicated at first, but it is due to interest rate differences between currencies. The hedged ETF can leak value over time. And then lastly, equity movement over FX movement. Over the longer term, movements in equity indexes tend to be significantly more dramatic and important than FX movements. For example, this Google Finance chart isn't perfect as they don't both have the same starting point, but you can see that the movements in the S&P 500 index absolutely dwarf the FX movements between GBP and USD. Of course, there's no way of knowing currency movements in the future, but this does highlight relative significance historically. Summing up all the pros and cons, I personally do not bother with GBP hedged ETFs, but I can understand the appeal for some investors. It's worth weighing up the pros and cons yourself and making the best decision for you. To wrap it all up, FX impact isn't a fee and it's not a scam. It's simply a part of investing globally. Sometimes it works in your favour, sometimes it doesn't. A stronger pound means your portfolio might take a hit, but it also means your next investment buys you more. A weaker pound boosts your returns, but it also means your buying power has gone down. You don't need to obsess over it, but you should understand it, especially if you're comparing your returns to an index or wondering why your ETF seems to be underperforming. Whether you stick with non-hedged ETFs or explore currency hedged options, what matters most is having a long-term view and staying informed. Thanks for watching. If this helped you understand FX impact a bit better, feel free to drop a like, subscribe, and check the links below for tools like my platform comparison sheet and more investing resources.